And you thought that was it for the profile. All right, if that's not enough, there is so much more. You will be amazed at how incredible this tool really is. All right, there are more key reference levels that help us. And the beauty of this is our software platform is designed to give us all those reference lines. I don't have to sit there and add horizontal or vertical lines. All I have to do is click buttons and tell it which lines it should show me, and it does that automatically. Any profile platform worth its salt will do that for you. Now, there aren't many of them out there, but the good ones, all of them will do that. How many of you have used a platform that included profile capability on it? Okay, all right, so we have a couple of people that have. All right. And that's not unusual. Most platforms don't have the profile on it. All right, let's continue on here and identify all these other lines and what they really mean. Now, the people that designed this profile were professional traders, professional floor traders. And so they started looking at market activity and trying to discern and identify what really counts, what really matters, and identify that on the profile. And one thing that is always very, very important, in addition to the open of any session, is what we call the initial balance. Is anybody familiar with the term initial balance? Okay, very close. If you will agree to the first hour, we've got a deal. It is, in fact, the first hour of trading. That is the initial balance for the day's session. And that is a very important period of the day. Why do you think that is? Why do you think that is such an important period of the day? Very often it does. You are absolutely right. It has a lot to do with what is likely to happen for the rest. As a matter of fact, many of the floor traders often didn't do anything until after the first hour. For those of you who trade early in the morning or at the beginning of the session, I'm sure you've seen the volatility when the market first opens up. And most professionals will tell you that's the herd. Let the herd, do all the guys that phoned in and said, buy this at market, buy that, or sell that, or that's what's going on right now. That's all noise. Let the dust settle before I come in. So the initial balance is very, very important and can tell us some very, very valuable information. And it's the first, in this case, since it's the first hour, it would be, what are the two period letters for that first hour? Period A and period B. So my initial balance is period A and period B. Once again, you will never see what the initial balance is on any big chart. You can identify it by looking at the first two candles. Yes, you can do it that way, but and you can draw lines below and above those two candles, and you can create your own initial balance on a candlestick chart. So if you don't have the profile yet, at least you've learned today to take a look at that initial balance, because that's a very important part of the day. In this case, this is a unique initial balance because we're looking at the ES Mini. Does anybody trade the ES Mini here? Okay, good. We have one or two people. The important thing about the initial balance is also taking a look at the range of the initial balance. For the ES Mini, this is a rather wide, very expanded range for the initial balance. So that always gives traders pause. What's going on here? Are we going to start heading higher or lower? Once we see a range like that, and then we begin to see that period C, the third period that comes in, start to head higher than that initial balance, we know it's an up day, and you will begin to see a lot of buying at that level. However, be careful about your target expectations, because most of the ATR for the day has been consumed during the initial balance. Everybody familiar with the ATR? Average true range. Very good, thank you. If I ever use an acronym, or if you're not familiar with something, make sure you find out what it is, because often it's very important to know. Okay, let's define what the average true range is.
Can you say that again about ATR?
Okay. All right. If you trade any instrument, you should always know what the ATR for that instrument is, the average true range. Remember, statistics and probability are your friend in this case. So, first of all, for the ES Mini, we have an average true range for each day session. And mind you, the day session is different from the evening session. Okay? So for the day session, does anyone happen to know what it is for the ES Mini? 14. 12, 2 points, give or take. 14 is the average. And that will vary, by the way, sometimes from month to month and so on. So it depends also, are we looking at a year, 2 years, 10 years? So, 12, 14, we're in the ballpark. We're still friends. All right, so let's call it 14. If, in fact, my initial balance from $14.99 all the way to $15.10, that's what? How many points? $14.99 to $14.10, 11 points. Out of 14, that doesn't leave me much room to head much higher. But look at what happens. It took us another 10 points above. But that's why it's important to keep an eye on those kinds of things. The other thing I want to direct your attention to is look at the shadow volume profile. Does it mirror the activity? I only have a single A print during that whole initial balance. But what do you see on the volume profile? A bunch of price levels where there was volume. If I made you guess what kind of volume that was, what was going on during that A period with these bars at the bottom, were they buying or selling? Exactly. All right. So you begin to see a lot of buying. During the initial balance. So when I see this in the morning, big bars like that, and then I begin to see the A shoot up, I know that there's a strong buyer that has entered the market. There's my initial balance high. My price, now I'm adding a little more sophistication to our terminology. I'm distinguishing between the value area high for price and the value area high for volume. In this case, the green lines are for price. That's why I have the letter P next to them. Price value area high, price value area low, and we have the value area. Do I have a volunteer that's willing to tell me where we closed? Within value, below value, or above value on that day session? Okay, can anybody read me the close? 15.16.75, and that is accurate. And we did close right within value. And now I'm going to highlight two other key levels that you need to know. Let's see if I have it right there. The price point of control and the volume point of control. Two incredibly important reference lines on your chart that you will never see on any candle for any period. the price point of control, the volume point of control. Why are those two so important? The price point of control is that price during the session where the market has spent the greatest amount of time. Okay? So the market did a lot of time there, kept visiting this price, printing again, 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 at that particular price. All right, the next one is the volume point of control. And this one is more important than the price point of control. The volume point of control is that price where the greatest amount of volume was traded during the session. Now, which of those two do you think is more significant and why? Okay, I hear one for volume. Anybody for price? Okay. Volume it is. Volume is the winner. Now why? The question is why? Why is volume more important than price?
Because volume is actual trades being taken at that price, and price is just time.
Okay. Well, the time, there are trades also occurring during that time, but they're not of the same magnitude. Remember a little bit earlier when we were talking about smart money? Okay, what's the telltale sign for smart money? One of the telltale signs is volume. Remember, when it comes to the market, I don't care what anybody tells you, size matters, all right? It does. It really does, all right? So once I begin to see certain high volume levels, that number, I take a mental note, and this is why my volume point of control is always, I like to put it as a dashed line instead of a solid line. So my eye darts right to it because I know the big boys were here. This is a price level where they were active. Now, just as every candlestick tells us a story, a profile also tells us a story. And this profile tells us a very, very interesting story. And let's take it from the beginning. Where did we open? At about $14.99.50. Did we even have a single print below the open? Not a single print before the open. So every profile, just like any candle, tells us a story. Now, what does this profile tell us? And if we take a look at the profile, it opened at about 1506.75, approximately. Do you see where the O is under the A TPO? That's where the open is. Has everybody been able to identify that? We open right here at about 1506.50, and then look at what happens to prices. Significant drop. Bam! Now, what's interesting is I want you to take a look at the right-hand side next to A, and do you see those volume bars? All right, so obviously, up at the top, at the 1506.50, 1506, and at those levels, those big bars were selling. If you take a look on the right-hand side of the chart, you will begin to see another faded profile. And actually, somebody had asked a little bit earlier about that, and I told them to wait because that will come up in a later discussion. Did anybody notice that other profile? So we have two volume profiles. Okay, the volume profile on the right-hand side is the weekly volume profile. So this is an accumulation of a number of days. And in this particular case, I believe it was an accumulation of the 2 prior days. All right, now we open this day, and relative to the week, notice The bulk of activity for the week was up here in terms of volume. We have deviated away from the mean for the week. And notice what happens when we come down here about 2 or 3 standard deviations away from the mean for the week during that day. Pow! Prices jump up right away. So they dropped and skyrocketed. The main point that we want to make here is the importance of correlating the volume profile for the week with the day. The day doesn't happen in a vacuum, it happens in the context of the whole week. And remember, perceptions of value. Okay, the individual that's trading that day, they thought, whoa, just like you said, we're really dropping. This is what a drop. On the other hand, the perception of the individual that's trading on a weekly, what a steal. This is a wholesale price. Let me grab it down here. And sure enough, look at what they did. Brought it right back up. Now, having seen this volatility, how do I know now, what does the profile tell me, which way we're going to go? We'll take a look at what happens at period B and period C. Does period B extend the range of period A, meaning move the range higher? Okay, so now the pressure is to the upside. So we saw a very quick turn in the market. All right. Now, notice what is happening. We're moving back towards where the weekly value was. And you notice this area up here where the cluster of value was for the week. And notice now that the bulk of trading for the day ended up back in value, back up here. Back up there. Right. And notice now the bullish sentiment. Once it was recognized in the market, let me tell you, first of all, when you get this kind of a movement, prices drop this much, and then they're never allowed to even retrace back into that area. That's one big player down there that says, hey, we're buying anything if it comes down our way. And so all of a sudden, the market doesn't go their way, and it starts to continue higher. This is what we would describe as a responsive buyer in the market. And again, only are you able to detect this kind of market behavior only can be detected on a profile chart. You can never show me responsive, I guess you could on a candlestick, but not as clearly as you would on a profile chart. First of all, what do we mean by responsive buying behavior? Anybody familiar with that term? What's a responsive buyer versus an initiative buyer? A responsive buyer is someone who recognizes a deal in the market. They thought, wow, what a steal. Okay, I'm going to respond to this. And so they come in and pick it up at that value, and they buy a lot of it, and it starts to push it right up. When other players in the market see that occurrence, they're comfortable. There's a big guy down there that's willing to buy. We're going to, the smart money is buying. I want to be buying too. And sure enough, they continued to all buy. And if you notice, look at the extent of the volume up above, right around the point of control. Look at the size of the bars. We had a lot of buying. Okay. Why? Because we recognized the smart money was buying. They weren't about to let prices drop. So the pressure was on. And notice also what happens. When prices start to dip down here, they're bought up right again, brought right back up to the point of control. And notice how the lows continue to move up rather than extend lower. Okay, this is typical of strong buying activity in the market. Now, where did we end up the day? In value, above value, below value. Okay, above, we're in value, but above the price point of control. And notice where we ended, right on the price I'm sorry, the volume point of control. Now, I ask you, is this a random market that just happens to close on the point that happens to be the volume point of control? It's just chance. These things happen at random. Okay, there's nothing random about this market. You begin to appreciate the structure and the order, and that volume matters. And there was a lot of volume here, and that's where we closed. Now, it would have even been a more powerful close had we closed higher, but this is not so bad. I mean, look at how much of the range we never even touched. We just bypassed. This is a powerful buy. This is a very strong buy signal in the market. Now, when we look at a candlestick, do we say the candlestick is an indicator? Possibly. Okay, then this is possibly an indicator. I actually don't like to call it an indicator because it's an analytical tool. Okay. It is far more powerful than an indicator. It tells me a lot about what's going on in the market. The more I understand the profile and its elements, the more I am in tune with what's going on in the market and the actual market activity. And no indicator gives me such a breadth of information and a width of knowledge. Indicators are usually very specific. Is this an overbought, oversold condition? Those kinds of things are the kinds of things that you get from indicators. The best way to describe it, in my mind, is it is an analytical tool. So it is an additional arrow in your quiver. It doesn't mean we're going to do away with technical analysis, but just think of how much more of an advantage or an edge you have when you can also see the profile in addition to your other technical tools. Now, let me share with you, for instance, some interesting tidbits here. If, for instance, the next day session opens, okay, and we find that we gap up, am I willing to be a buyer or do I start shorting? Based on what you see here, the development that happened and the structure. Thank you. Yes, I would be a comfortable buyer. Why? Because the structure here demonstrated strong buying presence and a strong buying commitment, and also value was comfortable in this particular range and closed right on the volume point of control. Okay, so that's how I use that information. I don't then say, oh, it's gone up above value area high, so now I'm outside the range, I'm going to start shorting.
So if it opens lower,
okay.
Than the previous close.
Okay, if it opens lower, then I begin to study and see, is this again, do I want to be a responsive buyer now? Is this a deal? Is this a steal? Because the market will retrace. One thing that I want to highlight for you is an important feature on the profile, which is known as the single print. The single print is when you see a segment of prices with only one letter at that. That is a very significant development on the profile. Who has the wherewithal to push the market up and not allow it to come back into that area unless it is a giant? Right. All right. Big guy. Okay, a giant came in here. All right, so that's very powerful information. Now take a look here again. Did we ever get a penetration into this area? Another single print. Here's another. The giant is still present. Remember those footprints I was telling you about? Individual traders, not in their wildest dreams, unless you were Warren Buffett maybe, as an individual, could you create that kind of a move on an index. This is the S&P Mini. Now, you will never be able to see the equivalent of a single print as clearly as you see it on the profile. If in fact we were to look at the candle, it might identify for us this single print. Where's my open? My open is up here. So it would identify a little bit of that single print. How would it appear on the candle? Help me, how would that appear on the candle? A wick from the bottom up to the open. Okay, so that's why also wicks are important on the candles. So that it got pushed. But I wouldn't know the strength the same way that I would see it here. The second piece of it, this other single print here, no way would you be able to see that in a candle. That you cannot see, yes.
The length of the single print, is that significant?
Yes, the length of that would be the equivalent, because this happens to be the open right around here. So that's my open. We dropped, then we came back up. So on the candle, that would be a wick, a big wick up. Okay. So in some ways, that would be the parallel on the candles. But this one here, which shows the continued commitment of the big buyer, you would not see in the candle. Why? Because that would be part of the body. Okay. Another important level that you want to be able to identify, again, is the 150% of the initial balance. Remember, I told you the initial balance, first two periods of the day. The next level I want to identify is 150% of that range. Why do I want that? Because I want to know how extended am I, how far am I deviating from the norms of the day. So my 150% level is very important, and the second level that is even more important is my 200% of initial balance. So in other words, if I took my initial balance and stacked it above it and put another initial balance, that would be the 200%. So I ended up the day above my 150% level, but below my 200% level. When you analyze the market with the profile, you will find that about, somewhere between 85 to 89% of the time, when the market goes above the 200% of the initial balance, we see a retracement, at least back to the 150% level. So that's very helpful, very useful information. Certainly if I'm in a trade and I begin to get to those high levels, I would want to at least be taking some of my profits. Or if in a bullish trend, I wouldn't be so eager to take a short, but certainly it gives me legitimate points to begin taking some of my profits. Now notice all those key reference levels. Are they arbitrary? Am I grabbing them out of the air? Where am I getting them? From actual market activity. How do I know that the 150% and the 200% levels are critical? Past market behavior. Looking at what smart money does, okay? They usually don't take the range twice beyond the initial balance. So once I get out in that territory, I'm not I'm not saying it's impossible, very high probability a retrace will begin to occur. Always remember to distinguish between a retrace and a reversal. So retrace simply means we're going to come back down. Now, another thing I really want to explain to you why this is so important and this is so helpful, because the profile flows in harmony with the auction process in the market. And let me elaborate on that a little bit more. How does the auction work? I get somebody that's a buyer, they come in and they buy. Why don't they take the market up to the moon? Why don't prices just keep on going? What stops them? Sellers. Okay, what if there's nobody bold enough to sell? Fair price? Believe it or not, you need to understand how big money thinks and how their procurement or their buying algorithms work. I want you to think for a moment, you are big money. Now you're smarter than them because you're going to figure out how they do it. All right, and you have a position that you want to put on to the tune of $300 to $400 million. You're going to come in the morning, and yes, you know $14.99 is a good price, so I'm going to buy $400 million worth. Is that how you're going to do it? If you're going to do it, you're going to lose that big money in no time. All right, that's not how it's done. How does big money buy? Responsive buyer comes in, buys a whole bunch. We see volume. At first it was selling back here, and then they started buying it up here, pushed prices higher. Okay? They continue buying. What do you think happens in the market when other market participants begin to see that buying activity? I assure you, I am not the only one that understands and can read these profiles. Okay? The professionals, the floor traders, the guys that do this for a living, they immediately see the pattern and they begin buying too. What does that happen when everybody and their cousin starts buying? Prices go up. Me, Mr. Big Money, now I'm having to buy to fill my position at higher prices. Is that what I want? Okay. I will continue to buy to a point. All right? And then I'm going to pull away from the market. Let the others take it up. And guess what? I'm going to start selling to them some of what I bought down here. And I'm going to recover some of my money. Okay, so up here, these guys that are buying and jumping on the bandwagon, guess who's selling to them? The smart guy down here. All right? All right, okay, you guys want to jump in on the bandwagon? Fine. And everything they bought down here, they make a profit on when they sell to these guys. Okay? Well, what if they had also participated in buying up to about here? Okay, they're not going to make much money here on this inventory. So they're not going to sell that inventory. They're going to hold on to it. And what are they going to do? When price comes back to an attractive level, they'll use the proceeds from the profits from here to keep lifting the price higher so they can now make money on what they had to buy here. They're not going to lose any money on that trade. And they have the wherewithal to push it even further yet. And not only that, guess what? You'll help them. So will all the other locals and everybody and their cousin help them push the price higher. That's how their buying patterns are. They buy, create a directional move, and then they come to what's known as a stopping price. At that stopping price, we will begin to see a rotation, which you see right here on the profile. This tells me right away the big guy is starting to sell right here in this rotation. Because if they had continued buying at this huge volume levels, would I expect to see a rotation? What would I have expected to see? Skyrocketing price. Is it in their best interest to keep using their money to inflate prices and buy things even more expensive? Of course not. Now do you see how they make their money? All right. All right, so now smart money is selling to everybody else. Now, does that mean that smart money will no longer buy? No, not at all. That's the strategy. Buy, create directional move, come to a stopping price, begin selling to the new guys that want to buy some of the action. Fine, they're going to ride our coattails. We're going to take advantage of them too. And then we'll buy some more to push it a little bit higher. And when we take it higher, this is the inventory we will unload, what we bought back here. Now you begin to see why the profile is so useful, because it forces you to work in harmony with the market and understand how the market is working. Candlesticks are nice, but they really don't impart to you what's going on and what the real behavior is. I still hear people say in presentations, fear and greed. When you think about it, what percentage of trading taking place today in the market is automated? Computers, program. What percentage? 2% is automated. Approximately 75% of all traded volume now is automated. All right? Now, if that's the case, have you ever met a greedy computer? Have you ever met one that was scared? And yet people, you see fear in the market. What computer is afraid out there? You know, machines know no fear and no greed. What moves the market are algorithms. Once we understand the algorithm and what's going on and understand the process of how this happens, then I can tell you, yes, big buyer comes in, big buyer pushes. We come to a stopping price. We're now going to rotate. This is the rotation. Now, how do I know that we have arrived at a stopping price? Trick question. Well, actually not trick, but it's an easy question, but you need to know a little bit about the profile. Once I begin to see TPOs accumulate above 4, basically about 5, you've come pretty darn close to the stopping price. Now we're rotating. We're not moving higher anymore. As long as I have just 2 or 3 and sometimes even 4, as you see here, we continue to move higher. Once we start to stall, the rotation begins. So we've arrived at a stopping price. And then it begins to identify itself fairly clearly, because you can then count with your eye. But that's the sequence of the buying module. Directional move, come to a stopping price, rotation. Now, to finish the sequence, one of 2 outcomes could actually take place in that rotation. One, we could rotate and then go up and continue higher, or we could rotate and get a retrace and drop lower. Out of those 2 scenarios, if you are in a trend, which is usually the more likely? Let's say it's an uptrend, yes, then we will continue higher. And that's why when I hear some of my students say to me, who in their right mind would be buying this high? Look at where they took it. This is way too high. Well, certainly in their right mind, if they have inventory that they purchased here, they would be willing to buy it and push it higher so they could sell it to the others up at a high level and make more profit. All right. Why not? You know, if you had that kind of wherewithal in the market, why wouldn't you do that? And it happens every day. I can apply this tool to stocks, to Forex, to ETFs, commodities, futures, you name it. Now, the birthplace of the profile is in fact in the commodities market, and initially it came from the CBOE. That is true. But if you take a look at 80%, if not 90%, of the indicators that you use on the equities side, where do they all come from? Commodities. As a matter of fact, some of them are still CCI, Commodities Channel Index, right? A lot of the indicators, those guys on commodities had to figure some way to try to tackle that market. And that's why, but the same analytical tool applies to any instrument that can give me the data. And this data is available on stocks, ETFs, Forex, you name it. Forex has a slight caveat, because Forex is an electronic exchange, but it's not a central exchange. So the data is not always accurate, but there are ways to compensate for that. And that's a special talent and a special skill to apply the profile to Forex. So that's the one area, but don't ever think you can't use it. Now, no market will go up forever. There's no question about that. I don't care what instrument it is. The most important thing is I want the market activity data. Once I have the data, I can organize it and begin to interpret and analyze it. And whether it's corn, soya, whatever the commodity is, if you get me the data, I can look at the profile and I can interpret for you what's happening in that market. We've been looking at daily profiles. I can do weeklies, I can do monthly, I can do quarterly, you name it. We can do all kinds of things with the profile. So it's not just looking at the day.